Well, hello, TradeStation Nation, and welcome to our afternoon webinar. Today, our presenter is Mr. Bennett McDowell, the CEO of TradersCoach.com. His presentation says trade size really does matter. TradersCoach.com is a firm that has been built for you to take advantage of the latest trading technologies to offer you quality educational trading products and services. Today, Ben is going to talk at length about this topic. Now, remember, our presentation is for educational purposes only. All the symbols and all the trading ideas that we bring up here are for demonstration purposes. They are not recommendations. Our presentation is not a solicitation of any kind in any jurisdiction where any TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Remember that active trading is not suitable for everybody. Options trading carries a high degree of risk and is not suitable for all traders. Please read the disclosure information that I've pasted into the chat panel. Remember that options trading carries a high degree of risk and may not be suitable for you. The PDF that's available in the chat panel, it's not strictly about options, and Ben may not touch on them at all, but we're prepared in case those questions come up. At any rate, these items are available on the TradeStation website as well. Now, we are recording. The presentation will not be available later tonight. It will be available later this week on our TradeStation YouTube page and also in Video Station. Having said all that, I want to welcome over the CEO of TradersCoach.com, Mr. Bennett McDowell.
Don, thanks so much. Great to be here. Welcome, everybody. Can everybody hear me okay and see the PowerPoint slide to get started on? Just want to make sure a couple of you give me a yes out there before we get going. Audio's good. Excellent. Always nice when the technology works, right? Well, we're going to talk about risk control today. And, you know, when Don and I get together on the morning market briefs, we do a lot of talking about where the market's going to go. We take a look at a lot of stocks for entries and exits. But today we really want to talk about risk control because we don't really spend a lot of time on that. And it is a very, very important topic. How many people out there have some form of risk control they're using? Let's hope everybody says yes, okay? Because that's really important. You know, it's hard to be profitable in this business if you don't have some form of risk control. And risk control can take many different elements. So we're going to talk about that today. Good. I'm glad to see a lot of people are out there using it. So what we're going to do is talk about some formulas today that I think may even help you improve your current risk control system or add on to it in some form or fashion to make you a more profitable trader. So let's go ahead and get started. Don already introduced me, but I would love to invite everybody over to our website at TradersCoach.com. We have a lot of free information there that can help you both in psychology, trading systems, which we like to call trading tools, and money management, of course, as well. So come on over, take a visit, and see what we got there. Don also went over the disclaimers, and the disclaimer basically says there's risk in trading, but without that risk, there's no opportunity. So the two really go hand in hand. So it's important to realize that. We just want to make sure you fund your trading account with money that we call risk capital, money you can afford to trade with, and kind of know what you're doing with stops. And we're going to teach you about risk control today. I've written a variety of books, and three that are on the market right now is The Art of Trading, which really covers our trading approach, Survival Guide for Traders, and the Elliott Wave techniques as well. But I've also written a book on money management, and I'll get to that in just a minute because that's going to be our focus today. Now, I'm going to put a link up here because before anybody has to go, I want to make sure they get this. And this link basically is going to be for a money management free article. So get this, if you have to leave, you know, Don said it's recorded. You can always watch the recording later, but definitely take a look and download this particular free article before you go because you may not have a chance to do that again. So in this 5-page money management article, it's a PDF, so you can download it right to your desktop. We're going to disclose the formulas that we use to calculate optimum trade size. We're going to talk about risk of ruin in the article and so forth. So a lot of good stuff in there. So definitely take a look at that PDF file. All right, let me ask a question. Why? Why do we need risk control and money management, folks? Why? You know, I did one seminar in New York City one time for the Traders Expo, and I asked, you know, why do we need risk control? And one person in the group actually stood up and said, well, we don't. I never use stops. And I said, well, how do you control your risk? And he goes, oh, I really don't. And I said, well, how long have you been trading for? He says, a week. Okay. So, you know, just a matter of time for that guy. But how many out there in terms of risk control? I mean, why do we need it? All right. Because without it, we would lose all our money at once. All right. Optimizes our net gains, minimizes our losses, which is another way of saying, Tom, let our winners run, right? Okay. And cut our losers short. Absolutely. All right. If you don't have a money management system or risk control system for each and every trade you take, all right, let me know because I'd like to bet against you. Okay. Because it's only a matter of time before you lose. That trader would lose all of their money. No kidding. All right. So let's talk about it. All right, some losing trades are, of course, a normal part of trading. Nobody wins all the time. So it really comes down to how we handle our losing trades. So we're going to spend a lot of time on keeping those losing trades small because losing is a normal part of trading. Of course, you don't want to lose more than you win, but the idea is even if you lost as much as you won, if you used good risk control, you actually, believe it or not, could be a winner. Okay. All right. So your goal, like we discussed already, is keeping those losing trades small and let your winning trades run. You must develop a systematic approach to money management. What does that mean? What's a systematic approach mean? What's that? It's a fancy term for what? Don't get off the hook. Everybody's got to participate here. Clear set of rules, okay, that you can apply on all sorts of markets, all time frames. Structure, good, William. Good. That's right. It's something, it's kind of like a cookie cutter approach to risk control. It's something you can apply on each and every trade, each and every market, and each and every time frame, right? Okay, so now that we know what our goal is, okay, the next question is how, all right? What you want to do is when you get ready to enter a trade, whether it's long or short, you want to be able to have some type of way to calculate your trade size for each trade. In other words, calculate your percent to risk. Those are two very important things we got to talk about today. We have something at traderscoach.com that's very inexpensive called the Trade Size Calculator. This is a piece of software that has the formulas built into it. Now we're going to go over the formulas in just a minute in this program here, but this makes it a lot quicker, especially if you're a day trader or something where you need to just punch the numbers in and have that information right away. Percent risk, we recommend 2% as a general rule of thumb. But if you have something called the Trader's Assistant, which is another piece of software we have for record keeping, it'll actually calculate the exact percentage you should be using based on your closed trades. So in a nutshell, money management or risk control, really it allows you to be wrong, right? Again, we're not always right in the markets. It helps control risk, takes into account that every trade can be a potential loss. I often think that really separates the pros from the novices, is that the professional traders are very optimistic every time they take a trade, but they're also very realistic in realizing that some of their trades, even the ones they think are the best, could end up as potential losses. So the door that separates the pros from the novices is really risk control. Okay, very, very important. And it's a state of mind. Now, what I mean by that is usually what's interesting is, you know, novice traders. Remember that guy I talked about that didn't use a stop that had been in trading for just a week? He's a novice trader, all right? His state of mind is he has no concept of why he really needs risk control. Most people don't develop a concept of money management or the need for it until what? Until what? Anybody? Until what? They lose, right? As Joshua says, absolutely. And they usually lose big, all right? Then all of a sudden, money management becomes a real serious item to be taken care of in becoming a profitable trader, right? So that's very important. So that's what I mean by state of mind. So another goal of today, and you attending today, is to really reach you, especially if you're new, before you have that large loss. So hopefully what we can do is you can, take the information we're going to teach you today, apply it so you avoid those large losses, okay? That's important. All right, let's move on here. We're going to talk about how much to risk on each trade. We're going to talk about calculating trade risk, calculating trade size, risk management or the risk of ruin, and effective stop loss placements. So before we get going any further, let me just ask one more question here. Now, you don't have to type in, but I want you to be thinking about this. All right, what causes traders not to use risk control? And then I want you to think of a personal experience where you suffered an excessive loss because you did not use risk control. And then I want you to ask yourself, why did you not use it? And what did the experience feel like? Okay? Think about that. Everybody's going to have their own personal relationship to the answer to this question. But a lot of times, the answer will be you didn't have really a structured approach to risk control, which is what we're going to take care of today. And when you don't have a structured approach, you tend to trade more from the gut, okay, and not have that type of safety net that you need that risk control provides. And I can assure you, it probably didn't feel well. I can remember back in my early time of trading, I was in an options trade, applied materials trade, going the wrong way. And I was losing a ton of money to a point where the loss was gotten so big that I couldn't take it. How about that? Have you ever felt that? Where you started out with a little loss, you said, okay, well, I'm still going to stick with it. This is just a little pullback. Then all of a sudden the loss increases. And all of a sudden you start losing sleep at night. Your wife starts to ask, hey, what's wrong, honey? Oh, nothing. And then you keep going. And then all of a sudden you've got this loss that's like a animal, gnawing at your like an alligator, okay, about to eat you alive. And it becomes so big, you can't even, you're like a deer in headlights. They're frozen, all right? And it's a terrible feeling. So the idea is this is why you have to keep those losses small, because if you don't, you can get yourself in big trouble, both financially and emotionally, very quick. And for me, it took me quite a while to recover from that, not only financially, because the loss was large for me in the beginning, but emotionally too. I mean, a little bit of emotional repair there. So anyway, the idea is we want to try to, again, get to you before you have to go through that, because it is no fun. All right, so healthy money management, or the psychology of it, begins when you truly realize that each trade's outcome is unknown. How many people out there have taken a trade and they thought it was going to be one of their best, and it ended up as a loser, and yet they took a trade they thought was going to be marginal, and it ended up as one of their best? Everybody has an experience like that, right? So that happens. So you've got to use it on all trades, no matter what you think. Okay, so state of mind, okay? That's the important part. All right, let's talk a little bit about trade risk versus market risk. Does anybody want to take a shot at what they think trade risk is? Anybody? What do you think trade risk might be? If I was in a classroom, I'd be pointing to people right now. Okay, individual, my risk. Okay, how much you can lose in a position? Good, I like that answer. How much you will lose. What's market risk? What's market risk? Well, let's take a look at these. All right, trade risk is something we actually can control, and we control it through our trade size or position size. And we're going to cover how to calculate that in just a little bit. But it has to do with your entry and where your exit would be, and your account size and that percent risk, and we said 2% risk that we wanted to do on each trade, right? So when we control our trade size, or well, also known as our position size, I use them interchangeably. When you control that, you can control your risk, trade risk. However, market risk is something like a terrible event or some company announcement or something that causes the market to do something totally unexpected that it can do. It's always possible that it can do, but it doesn't do it often. Maybe it does it 1% of the time. But it may cause the market to jump or gap past your carefully chosen stop, and therefore kind of screws up your risk calculations because now you're susceptible to more risk than you thought. So trade risk is something we control if we get out in time at the proper stop loss placement area. And market risk is something we have no control that does happen in the markets. And the only way to limit yourself is how much or the size of your trading account, how much you're trading with. Okay, that's your account size. This is why very wealthy traders don't always trade their entire net worth, because if a market risk event occurs or happens, all right, they may lose a lot more than they thought possible if they were just worrying about their trade risk. So I think you got to understand those two factors. So look at your account size that you fund your trading account with as risk capital. This is why you have to look at it as risk capital, because market risk can expose it. And I think that's important to cover because the two are a little different. All right, next thing I want to talk about is risk of ruin. Now, what is risk of ruin? What's the risk of ruin? Anybody know out there? Anybody want to take a guess? Lose everything in your account, okay? Blowing up an account. How long it takes for you to lose all your capital? All right, these are all part of it, okay? Risk of ruin is basically, if you have a toss of a coin, all right, 50% of the time it'll be heads, 50% of the time it'll be tails. Hopefully, if you're using a trading system, you're putting that risk of ruin, okay, in your favor, but you're only putting it in your favor if you're careful about making sure you keep your losses small, because if a loss turns into a large loss, that can throw off the risk of ruin, right? Okay, so first thing we want to do is talk about trade size and all that kind of stuff that helps put that into some type of jargon we can understand. The other thing you have to understand too is win ratio and payoff ratio and what these mean. The win ratio is how many trades do you win versus how many trades do you lose. And the payoff ratio is how many dollars do you make for every dollar you lose. Now, if you're not calculating this on an ongoing daily basis, you need to, okay? Start doing it. All right, so the win ratio, payoff ratio. And they're kind of married, okay, because we're going to talk about that a little bit. Okay, so the win ratio. It's the number of wins, like we said, divided by the total number of trades. For example, a 60% win ratio is basically 60 divided by 100, okay? So if you were, let's just say, winning, you take 100 trades and you won 60, you'd have a 60% win ratio. Now, let me ask you something. Do you think that's pretty good for a trading system? If you're winning 60% of the time, do you think you can be profitable? Good. I'm glad to see a lot of people are answering yes. Most people, and excellent, I like that too, Neil. Most people think 60% stinks, all right? But that's because they don't realize about risk control. And actually, people that really say, well, I win 80% of the time, probably it's kind of like accounting. They're probably looking at a certain time period where they may have won 80%, but over time it probably settles much lower. Okay, 60% is really good. Okay, And as William says, as long as your loss ratio doesn't blow you out. That's exactly right. So 60% is good, provided we keep our losing trades small, right? Good. All right, payoff formula. What is it? Okay, it's the average winning trade divided by the average losing trade. For example, if your 300 is your winning trade divided by 100, you have a 3-to-1. Is that good? Is that good? You betcha. Okay, 2-to-1 is good too. Actually, anything over 1-to-1 is pretty good. You can actually be a winning trader if it's over to 1-to-1, then you have a system that wins more than 50%. Okay, but 3-to-1 is even better. Okay, so that's good. All right, this little table kind of summarizes this notion of payoff and win ratio. Notice here that if I have a win ratio of 55%, which I circled in green, and a payoff ratio of 2-to-1, that I only have about a 0.2% chance of going bust on the risk of ruin tables with 10% of capital at risk. Okay, so that shows you that, even though I'm winning just 55% of the time, with a payoff ratio of 2-to-1, all right, chances are I probably am not going to go, I don't have a good probability of going bust, do I? If I win 60% of the time, which is the one right under that, it's 0%, okay? Let's keep going here. Take a look at another one. If I have a win ratio of 45% and I'm only winning as much as I'm losing, then I have a 100% chance of going bust. That makes sense, right? So this kind of gives you the relationship between the payoff ratio and the win ratio. So we have to be aware that if we don't keep those ratios in line, that the risk of ruin is really possible. Okay, so we have to implement this awareness into our money management strategy. Okay, we want you to calculate and stay within your risk parameters on any one trade. Again, a rule of thumb is 2%. Some of you listed some books there that had listed that as well. And it's probably a pretty good guideline. Sometimes if you're keeping track of all your trades and closed trades and you're doing the calculations, you may be able to risk more or less depending on how successful you are. Okay, so that's something that is good to know. But 2% is what we'll use today and probably a good standard going forward. Now, another thing, I coach a lot of students too, and another interesting thing, and one of the questions I ask them usually on the first session is that, what trade size or position size do you trade? And a lot of times they'll always say 1,000 shares or 500 shares. It's always some round even number. And as soon as they give me that round even number, I know they're not doing risk control the right way. And the reason I say that is because the number needs to be, you need to have your stop loss set on a place in the market that makes sense. And in order to do that in relation to your entry, your trade size is going to be different every time. Okay, so usually if it's the standard, it usually means if they're doing 1,000 and they're using any type of risk control, they're moving the stop based on making the 1,000 or 500 shares work, and it usually has no relevance to any support level or anything in the market itself. And so therefore their chances of getting stopped out increase greatly. All right, now here's the trade size calculator again, okay, and this is where you put the 2% in, but let's move on here because we already looked at that. Instead, I want to give you an example. Okay, let's go through this example. Let's say you have a trading account of $50,000 and you're trading with a margin account that allows you to margin 50%, and that varies from broker to broker. But this increases your buying power to $75,000. You trade using the 2% risk rule, and your trade entry on this example is 26.99 per share, so it's a stock, and your initial stop loss is at $25.45. And your commission in this example is $10. All right, next question is, what is your maximum trade size? And it gives you 4 answers possible. And I certainly don't expect you to be able to answer that now unless you know the formulas. So the first thing on the formula I want to go through, and this is what's in the trade size calculator, but calculate your dollar risk, and it's very easy, okay? You take the account size times the 2%, and it equals $1,000. So that means you can afford to lose $1,000 on a trading account capital of $50,000, okay? Very simple. Second part of the calculation is where we take that $1,000, subtract it from the commission, so we get a net figure, okay, $990, and then divide that by the difference between the entry and the stop. So if the difference in this example is $1.54, then 642 shares is the maximum trade size you can trade on this, and if you lost, you would be losing no more than 2% of your trading account, minus commissions. Now, if you put this information into the trade size calculator, and let me grab my pen up here, we start out, let's see if this works. We start out here with 50,000. Let's see where I put that up there. Okay, then we got the 2% risk. We got the entry. We got the exit. We put our commission. And then we calibrate the calculator because it's stocks. 1 point is $1. If you were trading the S&P E-mini, you put it on futures down here, okay, and then put that on $50 because 1 point in the S&P E-mini is $50. Margin is 150% because remember we said it's 50% margin account, and then you hit calculate, all right, and it gives you the results. So your loss on this would be $998.68. This is how you keep your losing trades at a minimum. And a minimum we've determined here is 2% of our account size. Okay? Very simple. Let's move on. Let's take a look at another one. All right, let me see if I can stop the pointer. I think I did. Okay, so now going back to our question here, the answer is 642 shares. All right, let's take a look at number 2. All right, we're going to do the same type of thing, $50,000 account, a little bit different type of question though. With the 50% margin, increases that buying power to 75,000. Trade entry on this one is 91.49, and your initial stop is 90.23. Your commission round trip is 51.22. Back in the days of a full-service broker, right? How much is the total cost of your initial trade with a 2% trade risk calculated? So now we're not looking at the loss, we're looking at how much buying power is it taking to do this trade. So let's move on. All right, first thing we want to do, okay, is you use those formulas before, or you can use the trade size calculator, put them in, and we get 753 shares for the trade size. Now, if we lose on this trade, we're going to lose a full $1,000, but that's 2% of 50,000. However, we want to also determine what the buying power is. So we take 753 shares, multiply it by the 91.49, and we got 68,891.97, and we only have 50,000 in the count, so we're going to be using the rest on margin, all right, because you have a marginable account. If you did not have a marginable account and you put 100 in the calculator, it would have lowered the number of shares to the amount in the account, okay? So the basic thing to take away from this is that when we say 2% risk, it's not that you're just buying $1,000 worth of a stock. It's that your loss can be no more than 1,000. So it's important to realize that. And here is the answer. Okay. All right, now here's one for the futures market. Okay, S&P E-mini. Again, $50,000 trading account. All right, the margin requirement in this example is 3,500. That's going to vary from broker to broker, and if you're a day trader, that may even be less. Okay, you are trading using 2% risk rule. Your trade entry is This amount, 1,088.25 per contract, and your initial stop loss is 1085. Your commission is $10. What's your maximum trade size in contracts? So in this, we're going to go back to our formulas. And again, these are the same formulas that are built into the trade size calculator. So you could use the formulas, or you could buy the trade size calculator. It doesn't matter, okay? Whichever, suits your fancy. But the idea is this is the information here, okay? So again, 50,000 times 2% is 1,000. But this time, okay, we have to do something a little bit different. We take the 1,000 minus the commission, okay, and that's 990. And then we take the difference between the entry and the stop, and we have to multiply that by the point value. For the S&P E-mini, it's $50. Every futures has a tick value, which equivocates into a point value as well, so you know that. And then that gives you 6 contracts. So the difference is 162.50, 3.25 times 50. Okay, and if you did that in the calculator, you'll see it shifted over to futures down here, and you'll see the calculations. But look at the dollar risk. It's $985. Okay, so that's the risk. Now, of course, the answer is 6 contracts. Now, a couple questions for you now that you have kind of seen this. All right, the next example, okay, I'm going to show you this in a minute. I think I got a slide for this. If the distance between your entry and exit is closer than 575, then what would your trade size be? So let's just see a visual example. Hopefully, good. Okay, so I have just as an example, okay? So let's just say the upper green line where it says trade entry, we're going to go long at that price, okay, S&P contract. And the stop loss is down here. So we have to get out of the market. The raw risk between the entry and the loss is $5.75. Now, my question here is, if the stop and loss were closer together, let me grab my pen here. Let's say, your entry line was here and your stop loss, well, we'll keep the stop loss down here. Let's say you got in a little earlier. All right, so the risk is going to be, the raw risk is going to be smaller. So what does that mean for the trade size? What does that mean for the trade size? Greater, good. Okay, so now you can see the relationship between the distance between the entry and the exit and how it's going to affect your trade size. And depending on what type of trading system you use, that if you have your stops below your support levels and you enter on your resistance levels and so forth, you're also actually capturing the average true range of that particular market at that time. So your stops and losses are kept accordingly. But in the way in which you want to do this is exactly that. So when your entries and exits are closer, your trade size goes up. But what's your loss going to be? Let's say, okay, I had more contracts in this example when they're closer together. Is the loss going to be more, less, or the same as when it was way up here at the green line? Same. Good. Good, because that's, you see, that is the variable that's not a variable, because the percent risk keeps that in check. The variable that changes is only the trade size. Now, just so you know, one more thing. Whenever you calculate an initial position, remember how I calculated the buying power, okay? You're going to have to take that into account by lowering the account size in your formulas and in your calculator by the amount you spent on the first trade, because you don't have that money anymore in the account that's being used, okay? So that, in doing that, you're automatically going to lower your risk in multiple positions. All right, let me erase this line here. Okay, everybody got that right. All right, so, any questions so far? Let me just bring up, because somebody brought up options a while back. there's a couple different ways to control risk in options. You can use the trade size calculator, and let's say it, if it gives you, 500 is your maximum trade size, then that's 5 contracts of an options. But you got to get out where you're supposed to get out. In other words, when the underlying asset goes below a price, you got to get out. The other way of controlling trade size or risk control on options, which is much simpler, is if your 2% risk says don't lose more than $1,000 and you're buying an option, then make sure you don't buy any more than the $1,000. So make that your cap on your premium that you paid. All right, there's pros and cons on both types of approaches, but either one can be used. All right, so this is the money management article again. Let me just put this link in here. This also has the formulas in it. Now that you know what I mean by formulas, so you don't have to write those down or watch the video again. So the formulas are in here, and you can take a look at that. All right, let me see. Let's go on here a little bit more here. All right, so hopefully now, okay, I've added some structure. We didn't talk about stops. Now, stops, okay, can really be something that we could spend a whole hour on. There's many different methods on setting stops. Some I like better than others. And, maybe we should do a webinar one day on just stops. But most people here are pretty savvy, and they're using some type of approach where they, know about risk control. And if you don't, you certainly know where you're getting out. But the idea is stops is something you do need to take into consideration. And so your whole formula here for your immediate action is geared around letting your winners run and cutting your losers quickly, okay, making them small as possible. And when you calculate your trade size, that puts you really far ahead of many of the other traders in doing this. Really important. For example, let's just go back to the fact that let's say you had a system that was winning 60% of the time and losing 40% of the time. Well, out of that 6 times, I don't know about you, but you can do the calculations on your own for your particular approach. But I usually have a really pretty good win on one of those 6. I mean, not just 10%, more like 50, 60, 70% sometimes. And think about that in compared to limiting my loss on the 4 losers out of 10, where I'm losing 2% of my account, but yet on the winners, I'm winning, okay? That's how you become profitable in trading, all right? But you have to keep the losers small. That's the key, okay? So, yeah, Bill's asking, will lower margin on futures, trade size? Well, the margin will come into effect to affect trade size because the calculator and the calculations do take that into account. Okay, so lower, but that's only if the trade size gets capped because of the margin instead of the risk, whichever comes first. Okay, so immediate action today. Calculate your trade size on every trade. If you're not doing this, I want you to get in the habit of doing it. Use initial and trailing stops also on every trade. When you enter a trade, you should know the price level in which you have to get out. In other words, the trade is no longer viable. So that, and after it moves profitable, then you want to have a method of trailing stops. Trailing stops is the most trickiest because most people never make it to a target point because they end up getting scared and moving their stops too close. So again, that's something, hopefully your trading approach has a structured way of doing that. If not, come see us at our website, okay? Because we have a great approach to that. All right, so those are 2 important things you can do right now after this webinar. Calculate your trade size on every trade and use initial and trailing stops on every trade. All right, how? Using the formulas, okay, in your free money management article, and use key levels of support for stops. Again, that's a very general term, and I could spend a whole hour on stop loss placements and how to do it. But generally speaking, I'm assuming you have some form of legitimate place to put your stops, not one based on emotion. That's really key. And then if you want a more automated approach, the trade size calculator is available for you as well. All right. And then finally, by acknowledging the good and the bad of what could happen and by fine-tuning your money management system, you will be on your way to greater financial awareness. The optimal F, Joshua, and the Kelly formula, we actually, in one of our other software tools called the Trader's Assistant, take into account that, okay, but it's not an end-all, okay? And it's a pretty complicated topic at that point. So we'll keep this pretty basic so you can actually leave the webinar and start using this stuff. A lot of things on risk control, if you start getting very technical on it, can be a little overwhelming, and you'll find most people will just not use it. So we want you to use it, and we find that this type of method that we're talking about here with these very easy to use formulas, but very, very good formulas, will keep you out of trouble and keep those losing trades small. All right. So any last minute questions? I think we're pretty much at the end here. Let me just see what else is here. Always use risk control. Okay, that's a good one. All right, that's a key. All right, yeah, and that's it. Okay, so we're located in San Diego, and you know, that's our information there. So let me just see if there's any last minute questions. Did you find this helpful, folks? Okay, we didn't want to get too complicated because, again, we want you to use it. Excellent. Okay, good. Excellent. Well, that was our goal. Okay, good. Good. Because really, I mean, you know, risk control is kind of like a dull topic when it comes to trading. It's much more exciting to talk about entries and exits. But you really have to, have risk control in order to be successful with this business. CJ, if you download that report, we'll have your email address, and we'll end up sending you something on the calculator, or you can go right to our website, okay, at traderscoach.com and look under software and then go money management, and it's in there, okay? There's two types of money management software, Trader's Assistant and also the trade size calculator. So you want the trade size calculator. That calculates trade size. That's what we covered today, okay? That's the formula. All right, well, I think I answered the question. Good, we were a great audience as always. And Don, I want to thank you, and Christina, who's also here from TradeStation, thank you very much. And Don, I will see you tomorrow morning, bright and early, for the TradeStation morning brief, which I love doing each and every week on Wednesday. So if you haven't attended those, folks, definitely stop by. We have a lot of fun. Also like to look up stocks. If you have any stocks or ETFs you want me to look up to see what they're doing, I can show you how our tools work on that as well. And that's tomorrow. We'll be here at tomorrow at 6 a.m. my time in San Diego, 9 a.m. your time on the East Coast, okay? All right, so that's it. Thank you so much, everybody. And Don, I'm going to turn it back over to you. And again, thank you so very much. And oh, Gene just put up a link for the trade size calculator, okay? And that's oh, good. So you gave him the special offer one. Okay, that's good. That's a really good price, okay? It's almost, yeah, $19. So that's like going to Starbucks. You should be able to get that. All right, so Don, back to you. Thank you very much, everybody. Have a great one, and it was wonderful to be here.
Ben McDowell here at TradeStation. Thanks very much.